Today we have with us Ben Dow. He is the St. Louis real estate ninja, and he also has a property management company called Dreamweaver, right?
Yep, Dreamweaver Property Management.
Dreamweaver Property Management. Awesome. So I'm excited to have you here. We met like a year ago, right?
Yes.
Right around then?
Yes, and now you are my preferred lender.
I love it. Thank
I
you.
like helping real estate investors, out-of-state investors. I have an extensive background in it, so thank you for
Right.
helping me fund the loans with my clients.
Yeah, no, thanks for trusting us. We know it's a big thing. We so to that point with investing. So you have a cool story because yours is a little different. You didn't start out in real estate and then get into the investing world. You invested in real estate first, right?
Correct.
And then you got into real estate so that way you could help others do what you did, which is build a rental portfolio,
Correct.
right?
Yes.
Before we get into that, tell us more about yourself.
Yeah, so I'm originally from San Jose, California, born and raised there. My parents are Vietnamese immigrants. So I was born and raised in California, which a lot of smart people are from.
Mhm.
And I'm really glad that I was raised there.
Yeah.
But it is one of the most expensive markets in America. But it's Silicon Valley, tech hub, being around Google and Facebook and hearing all these stories. But there is a middle class there that can't afford to live there. And a lot of my friends are still living with their parents. They have kids. But I
Yep.
eventually got engaged to my wife out there. And when we wanted to start a family, her family was out here in St. Louis. And she convinced me to move to St. Louis. And I was like, okay, is it really that bad? I thought it was like Oakland or something. Like I hear all
Right.
the stories. But actually, now that I've been here for over 10 years, I think it is a great place to live and one of the best places to raise a family as well. And
Yeah.
for real estate as well.
I love it. I think we do get from national news maybe a bad rap a little bit on how good of a community it really is.
Yes,
St. Louis.
yes. When you search online, you don't hear the whole story, and I am hoping to spread the word about St. Louis and all the positives it has to offer.
That's awesome. Yeah, it's definitely a big change from having the mountains a few hours away versus on the beach on the other side of it.
Yes, it's a lot different, but there are a lot of advantages here too. It's more affordable to live here. You can actually have a house and
Most
have
definitely.
space and be in a good school district and all that type of stuff. Where it's kind of hard to do that when the average price is $1 million per home.
Right. I'm working with a guy out in California right now that's buying, most of our stuff is in St. Louis, obviously, or Missouri, but
Yeah.
working with a guy who's buying a single family home in California right now. And it's been a while, but we've been in California for a while, but I forgot kind of what the house prices look like there and what you got for $1 million.
Yes,
It's
so-
pretty crazy compared to what you get for $1 million here.
Yeah. Lifestyle is great. It's just what you want, and I'm just hoping I'm hoping to help people build wealth here through rental properties, investment properties in St. Louis, and a lot of my clients are from California.
Yeah. It's amazing how many people from out of state notice that St. Louis is one of the really big markets for that.
Yes, especially for cash flow too.
No doubt. So what area of California were you in?
I was born and raised in San Jose,
Okay.
Silicon Valley.
Yeah.
Grew up through the tech boom. It started getting really expensive. I love the food. I love the weather. I love the lifestyle. I love the people. But was never able to afford a house for myself. I always had to have 3 roommates, sleep on
Yeah.
couches. Once you are about to start a family and to get married, I can't do that forever. So I put the family first, and I was like, let's just go to St. Louis then, and hopefully we can build a good life over here.
That's killer. Very cool. Well, real quick on that, I worked out at Mammoth Mountain for about 6 months. I was a ski bum, snowboarding.
Was that up north
Yeah, so
by
it's
Tahoe?
yeah, it's like an hour. It's like an hour, and maybe 2 hours from Tahoe.
Mhm.
But it's one of the bigger mountains. But I worked there for 6 months. Got
Oh,
to
it's
snowboard
so
6-7 days a week. That was right after college when I wasn't ready to grow up yet.
Yeah.
But, so then to St. Louis now. So you said came here with your wife to be with family, and you have 3 kids.
I have 2
right?
kids.
2 kids.
They're now in 6th and 8th grade.
Okay.
But there was a funny story where when we moved over here, her father-in-law has a few rental properties in St. Louis City, and we actually bought our first property during the downturn before we even moved here. So we closed on it, and then like a month later, we moved to St. Louis.
Yeah.
So it was not in the best neighborhood, and we bought it for very cheap, like $20,000.
Oh wow. Yeah.
But it needed a lot of work in it. So I guess it was our life savings. I don't even know how we fixed it up, but we eventually put in about $60,000 into it, 6 months, and we rented it out for about $2,000 a month. It's a 4-family.
That's awesome.
And our rent at that time was $550 in the city. So we used that money to kind of pay for our rent
Yeah.
And that's what I want other people to do. Before you buy your own house, possibly, maybe buy our income property first.
Totally.
Or live in one and house hack. But anyways, that was our launch. And our second property was from our wedding money. And we bought a single family home. And it was not in a great neighborhood either. And we'll go into that story.
Yeah.
But that kind of launched us. And then as I finally got a job here and my wife as well, then we started building a portfolio from there.
Very cool. Is there something that made you want to get into real estate? Was there like a catalyst that pushed you into it? Was it her dad because he had rental properties, or because not everybody these days does see the value in sweat equity? I think a lot of people want it just perfect the way it is.
Yeah, but turnkey.
Yeah.
Yes, and I think I had an advantage because I knew what I wanted early in life. So I already made a decision at 18 years old that I'm going to be a full-time real estate investor.
Okay.
And the reason was I had to be successful because we came from a single mom. I was afraid of just living check to check, and I decided like I have to be successful and take care of my mom. So what's the best way to do that?
Yeah.
Well, most millionaires are made through real estate.
Totally.
So I just decided at 18 I'm going to be a real estate investor, or I'm going to be in real estate. I didn't know what that meant. I didn't know if that meant realtor, fix and flip, rental properties. I really didn't know, but I just made a decision. I'm going to be in real estate full time. That's my ultimate career dream. So to know that at an early age, I didn't have to wander off. I was always focused on that. I bought a few properties out of state when I was living in California. I made no money for 6 years.
Okay.
And then once I moved here, St. Louis is a more affordable area. My father-in-law had a few properties in there, so I just thought it just made sense. I've always wanted to do it anyway. Let's start.
Yeah.
And that's how I took the leap into St. Louis.
That's great. So what for you then? It sounds like you did what the term now is house hacking, right? Buy a multifamily, live in one unit, build out the rest if they're not already renovated, and then rent them all out, and then that pays for your mortgage, plus some cash flow hopefully, and then you rinse and repeat.
There's a caveat to that story though.
Okay.
So this was in an area that I did not want to live in. So I didn't actually live in it, but I used the proceeds. I bought that before I bought my own house. So it was paying $2,000 a month gross, not with any expenses, but it was paid free and clear.
Yeah.
So my rent was on Hampton Avenue at $550. So I just used that money. It's kind of like house hacking, but I had my own apartment.
Okay.
But I used that cash flow to buy that.
I'm with you.
Wow. And then, so we didn't buy our own personal house until maybe our third house.
Really? Okay.
Yeah, because we had a little bit of cash flow there to keep us afloat while we were just making, average wages with our W-2s.
That's great. So then how'd you launch from there? Tell us about, I guess, your full journey with it, because you've got a great story with it.
Yeah, so my wife worked at Wells Fargo Advisors, Edward Jones. I was doing student loan collections in Creve Coeur.
Okay.
And just living below our means, we just saved and bought properties maybe a couple a year, a lot of multifamilies in South City.
Yeah.
And we just started doing that. So after 3, 4, 5 years, we had about 20 units in South City.
That's fantastic.
And so that gave us a momentum, and hopefully our lifestyle didn't creep as much as we wanted to. And so delayed gratification is a big part of it. After a few years, I wanted to be in better neighborhoods, less maintenance. Multifamilies, I feel, have more maintenance and more maintenance requests. So at that time, I took the leap and I went to mid-county, so like Overland and St. John. So then I started farming that area, doing single-family homes there, and did that for a few years as well.
Okay. Very nice. Very nice. So you were talking about back to people getting started. That's why you got into real estate then, was to help them do what you've done, right?
Correct. In St. Louis, you want to be in good, solid rental neighborhoods. From the outside looking in, there's a lot of cheap neighborhoods, and they're really bad. And it could be street by street, and certain townships are not as good as others. So, and I still have property in D-class areas. And you could do it, but you have to be prepared. You have to be mentally strong. You got to be ready for a lot of different problems.
Before we go a little further on that, can you explain then what D-class area is versus C-class and all that?
So there are 4 classes of neighborhoods, A, B, C, and D. A-class neighborhoods are the best school districts, the highest value properties, the most affluent neighborhoods. D-class is more that war zone with the lowest property, high crime. Usually there's not a lot of economic growth or Walmarts, and they're kind of depressed.
Right.
And then, so you want to be with the C and the Bs. C
Okay.
is more of that blue-collar neighborhood, probably under the medium home price, So in St. Louis, under 100,000, 100,000, somewhere in that neighborhood.
Okay.
B class is that upper echelon, better, not quite A, but it's still a solid, second tier neighborhood, safe. But the property values might be a little higher or around that medium home price as well.
Okay.
So I like to be in that C plus, B minus. That's that right mix of where it's safe enough, tenant quality is good enough, but not too problematic with some other issues you get with D class neighborhoods.
Okay. Sweet. Thank you. I'm sorry, I didn't mean to stop you in your story, but I thought it was good for people to hear.
Yeah, it's important.
Definition of
It's
what
important
that
to know
is.
that not everybody knows that, but I want to help people understand those areas in St. Louis because it's important to have the right location in the right neighborhood.
Yeah. So I stopped you when you were talking about going, starting to buy single family properties in those areas.
Yeah, I like it. I really do like it. And at that time, the prices were a lot cheaper, and I was buying properties in Overland, Breckenridge, for $40,000, $50,000.
Okay.
And renting them out for $800, $700, $900 a month.
Yeah.
So making that 1% rule. But over the years, those have gone up in value. So now those properties can be in the 80s to 120 range.
Yeah.
Rents go up over time. So you're building appreciation, building wealth, paying down your principal in good, solid neighborhoods. So I really like that mid-county area, and I recommend it for a lot of investors if they want to pay a little bit more now instead of going super cheap into that, that bottom area.
So I did want to ask you on that front, and then we can talk about some other, but there's a lot of different ways you can invest in real estate, right?
Oh, yeah.
But you've got the ones that are purely looking at cash flow now versus the long-term hold, where you get maybe a little cash flow, but appreciation long-term is big, and then hopefully build into more cash flow as you go on. Those are two pretty polar opposites. I wouldn't say
Yes.
polar opposites, but a very different mindset on investing. What are your thoughts on those?
That's a great question, Brian. A lot of times when you first start out, you just want cash flow, and that's what I wanted. So I didn't care if it was in the worst neighborhood. I just wanted the cash flow, and I just thought that I'd get enough income to quit my job. That was the goal.
Yeah.
And those neighborhoods can be worse, and there can be more maintenance, and there can be more evictions, and the tenants, and vandalism. So, yes, a lot of people go for that at first, but if you pay a little bit more, maybe like in St. Louis, maybe above that $150,000, $200,000 range, long term, actually, you'll do better. If you're making a little bit of cash flow, but in 5-10 years, the appreciation is 50, 100 grand, you're making more overall in the long term. I have properties. My second property, which was I bought for $45,000.
Yeah.
I rented it out for 12 years, and then by the time I sold it for the exact same amount. So there was no appreciation because it was in a D-class neighborhood.
Okay. Yeah.
So I did, cash flow it and whatnot, but it didn't go up at all, and it still needed to work when I sold it.
Right.
But my house in Overland, 10 years later, it's worth $100,000 more than I bought it for. So that's a big gain right there, and
Totally.
and it's a better tenant class, and so paying a little bit more for a better neighborhood that appreciates, I think, is a solid strategy. But a lot of people go for cash flow up front, and I totally understand that. You just have to be ready to maybe have more maintenance requests or have a good property manager or deal with those issues, and that's what I'm hoping to do, help people out, but do it in the most efficient way without having tons of headaches.
Totally. So it can be a good stepping stone, but to get to more of the long term, is that where you see more investors going towards, is maybe starting out in that arena, but then working their way into other B-class areas like you're talking about?
Yeah, usually that's the
long-term?
case. Yeah, usually you
Okay.
start off with the lowest, and then as you build something, then you understand, then you pay a little bit more. But in St. Louis, you can get solid properties in that 1 to 200 range.
Yeah,
They could be
totally.
fixed up. Let's say a university city, maybe a Florissant, maybe an Overland. good, solid B-class neighborhoods in mid-range school districts, and most likely from now, 5, 10 years from now, most likely it's going to be worth more, and you're still going, and the rent's going to be more, and you're in better neighborhoods. So yeah, just there are some cash flow neighborhoods that are just more for cash flow and less appreciation. Ferguson, I believe, is one of those where there's not a lot of appreciation, but the numbers look good on paper. So it's that right medium. So I try to get out of state investors to be in that more B class area.
Okay.
Just because to them, 100 to 200 is not that much compared to their situation for $800,000 or whatever.
Right.
So overall, I think they're just going to do better with less headaches.
Yep.
Yeah.
That's fantastic. So I know you'd mentioned you want to kind of talk about some other stuff. We haven't talked about your Dreamweaver property management. Do you want to talk about that now?
Oh, yeah.
Kind of go over that. So and you had told me about it, and I think it's cool that you're doing it because you have how many years of experience now in properties?
I've owned real estate in St. Louis for over 14 years now.
And you self-manage, right?
Yeah, I self-manage. I do have a couple of property managers, too, that I've tested out to help me with my portfolio, because now I want to help other people manage rentals in St. Louis as well. And there are certain areas that I won't property manage in, so I'm trying to make it as efficient for the clients and me. So I'm more in those B-class neighborhoods.
Yeah.
And trying to provide great communication and service and be fast with maintenance requests. And property management is really hard. It's a lot of work for very little money. So not everybody does it, right? No one,
Right.
Not a lot of people say, I want to be a property manager.
Yeah.
Most people want to do luxury or have big kitchens or whatever. But I've just been doing it so long that I feel like I can help people and do it in an efficient way. And I enjoy building a business that is a mom and pop, St. Louis, locally owned. So that's what I'm doing right now.
Well, I think it's a big advantage for you because having the 14 years of experience in self-management, you've been through a lot of scenarios.
Yes.
I'm sure you've seen them play out 100 different ways. So that's going to be huge in not only helping people buy real estate, but then managing the properties for them and how to react to those situations.
Yes, a lot of managers may or may not own them myself, but I owned properties for 12 years before I even property managed for others. So I do believe that there's some value there, and I can just make it easier for them. And so my goal is to help them buy it, help them manage it, deal with the tenants quickly and affordably. I believe that I'm pretty good with tenants as well. Not a lot of people are good with dealing with tenants, but I've been through a lot of situations, as you said. So tenants tend to get along with me. And just because you communicate with them the right way.
Do you have any crazy stories? Funny stories?
Yeah. So, over the years, I've had to do a lot of evictions earlier in my career, and there's still evictions now and then.
Yeah.
But I've always treated people with respect and grace. So I come at it from a situation where it's like, I do really like you as a person, and I'll help you. I'll help you move, but you can't afford the payments right now. Like, we have to evict you. I'm sorry, And so it's not this like, get the heck out of here and get your stuff now, which a lot of people do. And so I've evicted someone, and the sheriff came, and she was like, "Yeah, I'll be out. I'll give me an hour or two," and then and she'll be out, and she was out, and like 2 years later, she actually knocks on the same door. I used to live here, and my tenants call me like, she was looking for my phone number. She's like, "Oh yeah, hey, Ben, like, can I call him? Do you have his phone number?" Like, and then she asked me, "Do you have any places that you can rent to me?" And
Really,
you were really nice to me that time, and I'm like, I evicted you, a couple of years ago, but I treated them with respect. So a lot of times, even though things have gone south, we still get along.
Yeah.
With the tenants. So that's happened a couple of times, and that's just me just keeping an even keel and communicating with them bluntly, but in a respectable way.
Yeah. That's fantastic. That makes a big difference.
Oh,
it
yeah.
surely does.
Yeah, and that's what I'm hoping to bring now to others. There are a lot of stories that I hear about St. Louis property managers, and I can't get a hold of them, or they take a long time to get rent ready, and I understand that when you have 200 something units. It's hard to get with everybody, and I'm still small. But as of right now, I feel like I do a good job of talking to tenants, talking to my clients, getting things like being at a maintenance request within 1 to 2 days, and communicating with them about like, oh, we can't fix this today, but we have it scheduled for next Wednesday, and just being communicative on all sides helps overall in the whole, not letting things slip through the cracks.
I think communication is underappreciated or undervalued sometimes in business. That's something that I think we focus on a lot, is when they're in process, when they're buying a house. Not to go on off a big tangent, but you're talking about letting all sides know. So when we do Tuesday updates, so we call the buyer's agent, the buyer, the seller's agent, and title company, for that exact same reason, to make sure everybody knows what's going on, so we're all on the same page. And then the other thing is, and you probably have the same thing, if there is an issue, we can all work together to get to a solution. It just makes it a lot easier if you can communicate.
Yeah, I really appreciate that about Neighborhood Loans and you. You're always good at calling people, not just texting them, but you call me, you call the buyers, you call the listing agent. All that stuff keeps everything tight and efficient and close on time, and that's very important, and that's actually very hard to do nowadays in business.
Yeah, well, thank you. We try to make it easier. It's but I just think it's going back to what you're talking about with tenants and your owners and everybody. It just makes it so much easier, and that's, I think, half the battle after someone buys a house. I think a lot of the work really starts is finding a good property management company, because not only are they looking for a good property management company, they're looking for connections that you have, which are going to be contractors. When do I need a contractor versus when do I need a handyman, a good painter, a good sewer person, good plumber, good electrician, which I'm sure you have good contacts for all that.
Yes, and I have dealt with a lot of people over the years, and I have a few, but it's not like you never have like 10 great contractors. You always have that 1-2 good plumbers, 1-2 great handyman, and then sometimes they're busy. Like I have a lot of friends that I've worked with for over, let's say, 7, 8, 9 years. Yeah. And they're my friends and they're handyman, but it could still take them a month to get to a thing, because they don't work for you. They have all these other jobs to do. So what I hope is I hired my first in-house maintenance coordinator.
Very nice. Okay.
So he is handy. But having someone that actually works for you, that is going to be more effective, hopefully, down the road than getting contractors. And a lot of property managers have to have contractors because they might not have full-time work. Sometimes they're slower than others, and then you have them on a full-time payroll. It's really difficult.
So I think that's probably, you said not a lot of property management companies have people on staff for that. Is that right?
Correct.
So what all will they be able to do? Are they going to be like a handyman service, like rekeying doors, painting?
They can do rent readies too. A lot of them have rent readies, but they're just not like employees. They're still contractors, and the property manager will bill the client, with their services, but hopefully they're doing work just for that property management company. But usually that's not the case, because if someone else is going to pay them for a job or bathroom remodel, then they'll have to do that. Then your portfolio falls behind.
Totally.
And some people have a combination of if you have 500 units, maybe you have a couple of people on staff. But if you're a smaller brokerage, what I do notice is like most property management companies are like in that 100 to like 300 range, and then they just kind of stay there. Okay. It's really hard to get like 300, 400, 500. Just more staff, more logistics. Right. So, but I'm still small, so I can do a lot of things. Good communication, get things done quicker. But I'm thinking about that as I grow to, how do we keep that same level of service with 100 units?
Yeah, so what is your goal with it? Where do you see the company going? Property management side.
I want some in-house people. I do have the maintenance coordinator, and his job is to build his team of subs. Yeah. So and I'm just building him up, giving him a salary, and I'm giving them some projects under their belt, rent readies, just normal maintenance stuff that we always do, getting more experience, and then hopefully building a team. But as a rule of thumb, after every 100 units, that's like one full-time hire. So maybe after, that another full-time maintenance guy, and then maybe an office person after that. So my dream is just to have like 5 people in a little office like you guys, mom and pop St. Louis. Instead of 100 clients, I'd rather just have 10 clients and just buy a bunch of properties and make them wealthy and rich.
Yeah.
And have friends and and go to eat and play golf with them. That's
Dude,
what I would rather do.
I feel like that's a big part of it. When you really grow, is have to. What I'm learning from Greg and the coaching that I'm in now, I feel like it is. You are in life with these people. If you're gonna like grow a book of business and grow like in general with them, you are gonna be in life with them. So it's finding the right people. I think you're exactly right.
Yeah.
And I think that's been really the fun part of growing in this industry since coming over here. So I think it's exciting to hear you say that on your side too.
Oh yeah, yeah.
Is that
Real estate agents are very transactional. You do one deal, then you got to move on to the next deal. The average person buys a house every 9 years or whatever it is.
right?
But investors, they can buy multiple properties a year.
Definitely.
If I can help someone build a portfolio of 5, 10 rental properties, help them quit their job, that is the ultimate for me. So these properties are, lower price. There's still a lot of work, management, but I'm hoping that with the help of you and other people, just build a system
Yeah.
where I'm not running around doing everything myself and everything is running on its own with 3 to 5 people. That's what I'm hoping.
That's fantastic. Small and mighty.
Yeah, just going deep.
Yeah.
Going deep.
Going deep is right. No, that's fantastic. So you had mentioned you wanted to, I think, touch on some other things, right? As far as had some questions on our end.
Yeah. When I first started, I had a home equity line of credit,
Mm-hmm.
and I was buying these properties cash.
Yeah.
With the home equity line of credit, I would buy them for like, let's say, $40,000, and it was so awesome because it's cash offers. There's no underwriting process, so I'd buy these properties cash, and then I'd pay them off within whatever 6 months to a year.
Yeah.
And then once the balance was zero, then I'd buy another one and do the same thing. And
Right.
And I've always wanted to have a home equity line of credit on a rental property, but a few years ago it didn't exist really. Like you had to do a cash out refi.
Yeah.
But you had brought up that there might be options with a home equity line of credit on an investment property.
Yeah.
Can you tell me about that?
Yeah. So we offer them on investment properties. We've got 2 outlets for it right now, and it's up to 80% on those properties on
Of
investment
ARV.
properties. Yep.
That's good.
Yeah, which is pretty good, and it operates just like a regular home equity line of credit would on a primary residence. What I think is pretty neat about these is when let's say you have a $100,000 house, you pull out 80,000 of it. With our product, when your initial draw that you pull out, and usually there's an initial draw that you do have to pull at the beginning of it. You can pay it back right away, but there's an initial draw at the beginning. But that rate is locked on that draw, which is pretty cool. You don't have that in a lot of different home equity lines of credit. So then let's say you pay it back and a year later you want to use it again for another property. It's locked at what the rate is at the time you draw on that money again. So it's a pretty neat product in that you are locking in that rate on that portion of money used from that home equity line of credit.
Okay, so there's a certain minimum amount that you have to pull out right away.
In the beginning, yeah, and then you can pay it back. But yeah, there's
Yeah.
an initial draw you have to pull.
How much higher is a home equity line of credit than, let's say, your primary residence? Is it like 1 or 2 points?
Rate wise,
Yeah.
yeah, probably like 1 to 3 points. Depends on how much you're pulling out. If you're at 30% cumulative loan to value versus 80%, it's gonna be a difference. But
So it goes by tiers like that? So if you pulled out 60% versus 30%, it would be a different rate?
yeah, because the risk curve's different.
Yeah,
You're
makes
pulling out
sense,
more
but I've
equity
never
on
heard
it.
that.
Yeah. Yep.
Okay, that's cool. What if it's a home equity line of credit on your personal property? Like
Yeah.
your personal primary residence, would that be lower?
The rate?
Yeah.
Yeah, the rate's a little bit lower. Not a lot, not as much as you would think, but it's definitely lower
Okay.
for sure.
Yeah, I do like it where you are only paying the interest on what you have outstanding.
Right.
Usually. So if it's, let's say you have $20,000 balance out there and you've paid off 10 of it, then 10, the payment's going to be lower for that month, and then once
That's
you pay
right.
it off. But the flexibility of a HELOC is very powerful because you can make cash offers. I deal with a lot of investors that do hard money. There still needs to be approval. Conventional loans are a pain in the butt. So if you can get a home equity line of credit and use that for a down payment, or
Yeah.
maybe even buy stuff cash, it's pretty powerful.
HELOCs are. That's one thing I try to explain to people. I think it's such a big tool because you're right. If you put $100,000 line on your house and you never use it, there are no payments.
Right.
You
Yeah.
didn't make any payments. It's just money that's sitting there if you need it. And then once you use it, whatever you use, payments on that. So yeah, it's a dynamite product. And we think it is good, like you said, because then you can make cash offers on properties. And then when you're done getting the property, especially if you're fixing it up, doing the burn method, you can do a refinance on it and put a traditional 30-year loan on it after the fact if you want to, but you've been able to acquire property, fix it up, pull the cash back out, and reload and pay off your home equity line of credit, like what you were talking about earlier, and then rinse and repeat. Keep doing it.
With no underwriting and nobody looking over your shoulder.
Yep.
That's what I like.
It's a great asset. But yeah, for sure, doing it on investment properties, it's a fantastic thing. And if we can't do it, there are certain scenarios where we can't do it. We're more than happy. We've got relationships outside of us where we can send people to if it's something we can't do or if it's a product that we don't have. We're more than happy to introduce them to other relationships that we have, and we'll take their full package, like as long as they give us the blessing to do it. We'll take their full package, everything, credit, all that good stuff, and we'll pass it over to the next person.
So they don't have to do the whole
So
thing.
they're not sending all the documents to everybody again.
Yeah.
We're doing a nice handoff so it's all ready for them to go over there and just continue the process.
Yeah, that helps a lot actually. That helps
Yeah.
a lot for the client.
'Cause we know we're not always going to be the right fit. We'd like to be the right fit every time, but we're not. So in those cases, we definitely make introductions.
I was interested in your investor. So I'm just, a mom and pop investor over here.
Yeah.
You're doing a lot of loans for investors, I'm sure.
Mm-hmm.
I just kind of want to see what your typical client is doing. Like, what areas they're buying in? How is their cash flow? Like, rates are higher, or lower now than last year. Can you tell me like a typical?
Most of the ones that I'm working with right now, they're out of state.
Yep.
Like we were talking about, I've got some in California, right outside of DC, Florida, but just from all over, and they're buying in St. Louis, and they're buying in the C properties, the C
North
areas.
County?
Yeah, North County area. So they're buying like a lot of them are wanting to hit 100,000 or less and get that cash flow.
Okay, yeah,
Is what we're
that's
seeing
what
right
most
now.
people come to St. Louis for. That under
Right.
100,000. But I believe if you're around 100 or 150, that better quality, it's still going to be good.
So that's what we do have some clients now that are starting to see that they like their properties that are cash flow, but they're saying, hey, maybe if we did spend a little more money up front, we could get into those B minus or C plus areas, and maybe in the long run, it might be a better scenario.
Okay.
Not necessarily better, but different, go for the long-term appreciation. But a lot of them right now are going for that $100,000-ish property
Oh, yeah.
with 25% down.
Yep. Pretty typical for St. Louis.
Yeah, exactly
Yeah,
right.
So
So then Section 8, what do you get on Section 8 right now? It's
I actually like
for a
Section 8,
three
yeah.
bedroom. Oh yeah, it's not bad at all. For a 3-bedroom, 1 bath, you get, or 3-bedroom, 2 bath, what is it, 1,600 right now you're getting?
Depending on the area, yes. So I have mostly 2 bedrooms,
Mhm.
2-bedroom, 1 baths, and I can get 1,000 to 1,200 on a lot of them. And I bought those properties for under 100,000, so
Yeah.
the returns are really great. Section 8 is very consistent as far as the cash flow.
Right.
I do like it that if anything goes wrong with the tenant, you can call the caseworker.
Mhm.
They're not really trying to mess up and lose their voucher. So overall, I've had a great experience with Section 8, and
Yeah.
maybe 25% or 30% of my portfolio now is Section 8.
Okay.
So I really like it, but they're usually more that C class area, more cash flow, less appreciation.
Yeah. No doubt. Well, so you said there was another topic you wanted to go over. What was that when we were talking before? Was it you're looking at city versus county? You had something on that? Or we already kind of touched on that as
Oh,
far
yeah.
as different
Oh.
areas to buy in.
Yeah, for St. Louis, most people buy single-family homes in North County, but a lot of people also invest in the city, South City,
Right.
multifamilies. So all my multifamilies are in South City, and all my single families are in North County.
Yep.
Do you see anything with South City? Do you see anything, any multis? Do you do anything there?
Yeah, we do have some people that are looking at multifamilies in South City right now. I do think there's just a lot more of them in that area.
Yeah.
So when people are buying them, it does seem like South St. Louis is the spot where everybody wants to get them, and it's a little harder to get them right now
Yes.
because people are realizing
It's
hey,
pretty
these are-
competitive now. In my estimation, you want to be closer to Tower Grove. You
Mhm.
want to be Tower Grove South, Shaw. Once you get down to certain parts, I don't want to put them on blast,
Yeah.
but yeah, I'm in those neighborhoods, Grand and Chippewa area, like they're kind of lower, and I still have them there, but I don't recommend that to everybody.
Mm-hmm.
But so just pay a little bit more beyond Hampton, beyond, you know, Princeton Heights, Bevo Mill or something. So yeah, a lot of my clients like South City as well.
Yeah.
In the city, there tends to be easier to pass inspection, less regulations usually than the county. So those are the two main spots that I usually see: South City, and then North County.
Yeah.
But there are other pockets where if you pay a little bit more, Mid County, U City, Overland, St. John,
Totally.
those areas I really like as well.
Those are great areas, yeah. But you're right. We do see more North County for the buyers that we've been working with recently, for the single families, or if they're looking for 2-family, 3-family, and above. So South St. Louis seems to be the hitter. Memphis, Tennessee has been a good market. Are there other ones that you work in as well, or that you refer, if people are wanting to expand outside of St. Louis? Are there other ones that you suggest to people? Because I know St. Louis is where you're really at.
I'm super laser focused
Yeah.
on, and I don't pay attention to a lot of other cash flow markets,
Mm-hmm.
but in general, usually the Midwest or the South
Yeah.
will have, those $50,000 to $150,000 properties,
Mm-hmm.
Section 8 possibly. There are a lot of good ones as well. You do want to be areas where it can grow more, also landlord-friendly states.
Yeah.
And yeah, if you stick with those, you'll probably be in a good position. Try to make the 1% rule, and
Do you want
go
to,
from there.
if people don't know about it, you want to tell what the 1% rule is?
Oh yeah, so the 1% rule is just 1 month's rent is 1% of the purchase price.
Mm-hmm.
So if the purchase price is $100,000, you want to rent for $1,000, 1 month's rent.
Mm-hmm.
So if you're in that situation, usually it's a good deal. There's a lot of other economics that go into it as far as taxes, HOA, all these other things.
Right.
But in general, usually if you're around that, a little above, a little under, you're doing pretty well. But if you buy a $300,000 home and 1% of that would be $3,000, but you can only rent it out for like $1,700, that's like almost half. It's kind of, I mean, that's not really a cash flow investment.
Right.
It could probably go, higher in appreciation down the road. But I like the 1% rule in St. Louis.
Yeah. Have you been able to hit that the last couple of years with the higher rates?
All of my properties have the 1% rule.
That's awesome.
Yeah. But I am buying in lower neighborhoods.
Mhm.
In that C class, more cash flow. But
Yeah.
but now I am veering more into higher end where there's less than that.
Mhm.
But personally, I built my whole career on at least the 1% rule.
That's awesome. Well, I mean, you got a good background for it and a good track record to show that rule work.
Yeah. It's harder now.
Mhm.
Prices have gone. So keep in mind, I have been investing for 12, 13 years. I was buying when prices were half of what they are now.
Mm-hmm.
But don't wait for the best time. Always start now, I believe. Like
Yep.
people say it's like this or that, but most likely 5, 10 years from now, most likely it's going to be worth more.
Totally.
Most likely rents are going to be higher. All that stuff. But if you wait for 10 years and try to time the market, you're just going to be like, I wish I had done it back then.
I
So
think
no
the cost of waiting more than not is going to kick you.
yeah.
I mean, that people always thought the best time to invest, would have been in 08, 09, 2010. But the second best time to invest in real estate is now.
Yeah.
Like
yeah.
if you didn't do it then when prices were depressed, now is the best time to start. It's always a good time.
Yes, and if you have rental properties, then most likely you're covering your mortgage.
Mhm.
Most likely you're paying down the principal. You are paying down the principal. So even
Right.
that, you're just going to build some wealth with a little appreciation. Rents go up over time, tax deductions. So it just makes sense. It just makes sense to do it if you can.
Mm-hmm.
It's not as easy. There's a lot of work and repairs and tenants but for the most part, most people what they do is either have real estate or a stock portfolio like their 401k. So if you have a balance of that, and
Totally.
usually in the end, if you stay consistent and hold it for long term, then usually you'll be better off than you are today.
Yeah, we like that balance. We work with some good financial advisors that really see the value in both. Because
Mhm.
not all of them want to see you put your money on the real estate side. They want to keep it all
Yes.
in the market. But we work with some that do a real good job of balancing both sides of that. I think it's important.
What I do recommend though is maybe go all in at first
Mhm.
in one, for like 5 years.
Okay.
So a lot
Yeah.
of people that work corporate jobs, they do the 401k thing, they have everything in stocks. So then they come to me and they say, "Oh, I want to buy real estate now, but we live in an expensive market. Let's start now."
Yeah.
I did it the opposite way where I didn't buy any stocks for 10 years and I just I just bought rental properties the whole time, and now I'm
Mhm.
kind of like, I'm over concentrated. Let's do the whole stock thing. So I recommend if you can do both, I recommend going all in on one for at least a couple years.
Okay. No, it's great advice. Well, dude, it's been awesome having you on. Is there anything else you want us to touch on?
No, that's pretty much it. I appreciate you being here and helping my clients and helping us get deals done.
Yeah, man, we love working with you. Thank you.